Gary Wagner here, approximately 10:30 in Honolulu, 4:30 in New York on Thursday, the 21st day of November, 2013, and this is the daily report for gold and silver. After the dramatic fall that we have been witnessing over the last few days, yesterday being a pretty deep cut in the price of gold, we have not really a recovery as much as a stabilization going on today, with gold trading in essence unchanged and silver trading up about 12 cents. First to gold, 12.42 and change. Puts it up, as I said, roughly unchanged, up $1, down $1. Now it has hit a low of 35.90, and 35.90 is important because we've identified 12.36 as a pretty critical line in the sand, so to speak, so we will talk about that. The high 12.51.30, really no cigar there because that high would have come in really at the beginning of the day. We're looking at a 240-minute chart, and you can see we have had a series pretty much of lower highs as this market's been trading. Silver currently trading up actually about 12 cents on the day, with a low of 19.65 and a high of 20.18. Traders, you know my sentiment on silver and where I thought it almost really had to fall. And we mentioned this weeks ago. We talked about the fact that there really wasn't any technical support and resistance levels right in this zone. In the zone that I'm talking about is between 2070, call it, and then 1970. And I said once we broke through this particular point that we really had nowhere to go but $19, meaning that we would probably fall to the bottom of this line. On our daily chart, we can see that it's done just that, and we'll take a deeper look at silver towards the end of today's show. There can be no doubt, obviously, the bearish sentiment that has been existing in the precious metals markets continues to have a dominant effect in the market. Looking at a 240-minute chart, just so we can see how this market has really fallen through the month of November. Of course, the beginning of November, we already had a dramatic drop in price in which we saw roughly 1350. This was the high from this last rally here, coming down and just trading roughly sideways at around 1310. From there, it did make the drop, and this, I believe, is our secondary low right in here. We had a low of 1250 that came in prior. That was where this rally started, and this was that little clip up that we talked about. I had expected the market really to trade maybe as high as 13. I think the range I put in was 13 to 1310. It really failed at 1294. That was our intraday high, and from there the market really meandered sideways for a little bit, fell down 1270, trade sideways, and then comes in and makes these lows, with this low here at 1235 being a new low in terms of where the market's been ever since we have seen this dramatic price drop. Now, of course, when we begin to compress time on our charts, we've moved to a half-a-day standard candlestick chart, 720 minutes on this particular chart. It really illustrates quite well what kind of drop we had. Of course, this is 1365 as the market. This is really pretty much the most sizable rally that we have seen for over the last 6 to 8 months. But this dramatic rise was obviously very, very short-lived. Starts second week in October, takes us up to the conclusion of October, and then really it was all downhill from there. And if you look at the way the market falls, it falls dramatically and then tries to find a little bit of support right in this area. That's the 1310. That's that sideways action that we saw. It then falls easily below 1299, 1300, and it continues to drop until we hit this intraday low, 1260. This was that small little clip up, but if you notice, when we look at the short-term resistance line, and this was really a telling fact, simply looking at these highs here and these highs here, and if we carry it forward, so again, we've basically placed this resistance line from these points. As this market came up, I talked about the fact that it's probably going to run into this resistance line, and whether or not it breaks through that is going to be a critical piece of technical information to arm ourselves with. And once we saw that failure, of course, the rest, as they say, was history, because what we witnessed at that point was a continuation of the dramatic drop. And then, of course, this being yesterday's trading activity, and you can see by the size of this candle, it was a major spike down as minutes were released from last month's FOMC meeting, and the belief is that tapering now will begin sooner than later. Listen, I've gone on record saying I don't really think that we're going to see tapering begin this year. I obviously could be wrong, but the key is this as far as I'm concerned. With the program, quantitative easing, it was never a matter of it being to infinity and beyond. It was always a matter of a injection of cash flow into the economic wheels, so to speak, so that we could really ramp back up in terms of our basic economy and business getting done. The fact that they're going to begin to taper at some point is really no mystery. The mystery is, how will that tapering unfold? Will it be dramatic? Will it be a very subtle tapering in which they take the 85 billion and shave off 10 billion and 2 months later? Those are the details, and the devil is in the details as far as I'm concerned. But the market has voted, and they have voted with lower gold prices. As I said at the beginning of today's show, the intraday lows that we've hit, this 1235, 1236, is an important number, and this is the chart that kind of illustrates that. What we're looking at is a daily chart. This daily chart has been used by us over the most recent time period to look at the subcount behind our intermediate count, meaning 3, wave 4, and wave 5. Our subcount, of course, A, B, C, and we're currently working on our subcount of wave 5, which I believe is in 3 of 5, 1, 2, and we're currently in 3. That being said, when we put in our fib retracement, and the fib retracement is this last rally, which is 1181, call it, to 1430, the 76% retracement is 1237, and that's where that number has come from. There's two facts that we have to be absolutely aware of right now. And the first fact is that we have made a lower low than this last low. This last low came in at around 1250. Now we've got a lower low, which is taking us to 1235. Below that point, there really isn't anything on this chart, because we go to the 100% where we begin this particular retracement sequence. So this is a pretty critical number, because what it says is that we had this rally. The rally was significant, but once you've given up really more than 76%, the rally had no teeth in terms of being able to hold any kind of a price point. And that is significant, because if it cannot find support in this particular area, meaning the current trading range, or the current lows, I should say, at around 1235, if it cannot hold these lows, really the market will probably come in and attempt to retest these lows at around 1181. And to really put our current price point into perspective, looking at a weekly chart, and the weekly chart, of course, is where we have been keeping our intermediate count meaning 5, A, B, and C, this fifth being a part of a major third, major fourth. So this is our intermediate count, wave 1, wave 2, currently 3, 4, and I believe that we're in 5. If we look at where this low has come in, you can see how it's lined up quite eloquently to this particular retracement level, which is 1236. it's showing at 23%. And the reason that it's 23 rather than 76, it's where I put my top or bottom on this particular retracement line. But these numbers are all fractal. You can reverse them, you can change them, and the numbers will always kind of match and come out the same because of the fractal nature of Fibonacci retracement. So once again, when we look at this, you can see we are in a very, very tenuous spot right here, because on any kind of break, I believe that we could go ahead and retest these particular lows at 1181. Now, there's another reason that number is so critical. We talked about this a little bit yesterday. Let me go ahead and bring this chart in a little bit more. And this is the large retracement that we have added into this particular study, which starts really just below $700, takes us up to $1,900, that record top, and a 61% retracement of that is 1175, and that matches up with this first and currently the effective low that we have had ever since we have seen prices begin to falter, not only from 1920, because they fell very dramatically from that, but we were trading in this defined range for the longest time, 2011, 2012, 2013, in which we saw the market oscillate from highs of 1800 down to lows of the high 1500s, 1580, 1560. On the third attempt, it comes in. As it falls, this is our dramatic, really our line in the sand that we talked about. And when that market fell through, it fell through with a vengeance. You can just see how it falls. Tries to find some support, falls more, attempts a little rally, but then really breaks down and then hits our intraday low, this 1181. And that's why my belief right now is if this market holds, that's one particular scenario. But if it breaks through this particular level of current support that we have put at 1236 plus, we could really see this market lose some dramatic ground as it attempts to retest these lows here. So I think that we're still in store for some exciting price activity in the market. But at the same time, I do want to see if it can find any kind of support in this area. And of course, it is my current belief that the greatest nemesis, the greatest adversary right now that is really working in a bearish way to move gold prices lower is what I call liquidity theory. And it's the fact that when you look at these the equities markets, this is the Standard & Poor's 500, it just continually has been breaking ground and moving to record highs. And when you've got that kind of activity, you are going to get a lot of professional money as well as speculative money and individual investors kind of jumping onto this bandwagon. And this bandwagon, there's no doubt, it's been bright, it's been fast, it's been furious. So that's what I have been looking at. Any signs of weakness in the equities markets, I believe, could be bullish for the precious metals, but I believe a continuation of this dynamic rise in equity prices is going to continue to put downside pressure on the price of precious metals. And lastly, I do want to take a look at silver. Silver has hit our mark. In other words, it's gone to the area that we really believed it really had no place to go but, and that was really, call it 1970. But on a daily chart, it is up slightly today. It is in an area that logically could be supportive of the market. It's also a pretty critical line. Once again, it's at 76. There's nothing below it. We've already seen the market break through all the various points, 23, 38, 50, 61, till it finally dropped to this point. So this is going to be a really important area because, like gold, a break below this to me signals that really we are probably going to be looking at $18 silver if we look at 1180 gold. If we see gold hold and begin to find some sort of support off of the point we identified, 1236, we'll probably see silver hold. There is a slight variation of gold and silver in that in terms of industrial usage, silver is a widely needed and used precious metal, for industry. So with these ramping and raging equities prices, you're probably going to have an increased demand for the precious white metal. This has been Gary Wagner, wishing you as always good trading. Talk to you tomorrow for the weekly wrap-up and review. Bye-bye.